Hey, what's up, guys? John here. Fitch is now considering to downgrade America's largest bank, JP Morgan Chase.
Fitch is warning it may be forced to cut the credit rating of dozens of banks, including big ones like JP Morgan.
Fitch Ratings has issued a stark warning that it might downgrade several major banks, including the likes of JP Morgan Chase.
This is only just weeks after they downgraded some of America's other largely successful financial institutions and banks. This is only going to push interest rates higher, borrowing costs higher, and it's going to make it very, very challenging to get financing, whether it be for a home, whether it be for a commercial property, whether it be for an automobile or potentially a credit card in the very, very near future. So if you are an American and you want to invest in real estate, you have a game plan of potentially investing in this upcoming recession, and you don't really know what to do, pay attention to what's going on right now, and you'll be able to make some very, very clear, forward-thinking decisions based on current facts of what's actually happening to America and what's happening to our banking system. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's actually going on in America. And if you want to fix your credit score is, say, below 750, maybe you have a late payment charge-off, medical bill, foreclosure, bankruptcy, you have something on your report that's holding your score down, don't let it sit there. In many cases, it will stay on your report for 7 years from the date in which it was filed, sometimes longer. So if you need help, we'd love to help you and give you a free strategy session at mycompany.greatcreditfast.com. Take a look at this. Fitch warns it may be forced to downgrade dozens of banks, including JP Morgan Chase, right? So JP Morgan Chase, America's largest bank, here's how this all plays out. So why bond rating downgrades are the last thing banks need right now. Banks rely heavily on the sale of bonds to fund their operations, and rating agencies make it clear that those issuances could get more expensive due to a series of pressures making life more difficult for financial institutions across the country, right? Such a change from Fitch would put the industry rating below some of the country's largest banks, such as JP Morgan Chase, Bank of America, right? Thus, the credit rating for these giant banks would need to be cut, which could trigger sweeping downward adjustments for many of their smaller rivals. The end result is that investors will need more returns to own bonds of banks with lower ratings, thereby increasing costs for banks and putting pressure on their profits. We expect sponsorships from debt investors to be there, albeit at a bigger price. It's private equity, right? Morgan Stanley, analyst, it said in a research note last week, the risk is that the downgrade wave is persistent and continues beyond the third quarter. Most bank stocks fell yesterday. Well, what people don't realize is this is going to mean higher borrowing costs across the board. And if you look at where interest rates are right now, even if you have perfect credit, I'm talking an 800 credit score. Not many people have an 800 credit score. You're looking at 7.5% on a mortgage. The average credit score in America is a 698, looking at 8.2%. Right? Slightly above average credit score, 8.135%. Now, on a $400,000 purchase, $500,000 purchase, you're looking at like $4,000 a month. How many people can afford that? You have to make, call it $12,000 a month to be able to afford the average home in America, $144,000 a year. That's a lot of money. That is a lot of money. Well, look at how this is going to play out the next 30 to 60 days. They're not talking about this. They're just kind of, leading us on, saying it's this, and then a week and a half later, it's JP Morgan Chase, and then they're walking us to what I believe is the cliff's edge. So JP Morgan Chase, Jamie Dimon expects U.S. recession 6 to 9 months, right? Wow. U.S. banks are making it much harder to borrow money. It's only going to get harder because here's why. So 56% of student loan payments, 56%, right, of borrowers say they have to choose between their debt and buying groceries. And these bills are going to be coming due in about 45 days. 45 days. So you have 43.5 million Americans that are going to be, obligated to make these debt commitments, most likely unless something changes last second, 43.5 million Americans. Well, the average payment will be about $500 per month. That is a lot of money. So if you look at just how many Americans are over the age of 18, 259 million, right? Not all of them went to college. Roughly half went to college, but just for easy math, 259 million. And 43.5 million are going to have to start making these obligations. So about 16%, 17% of the U.S. population over the age of 18 is going to start having to make these large payments. Well, only half went to college. So it's probably north of 25, 30% are going to have to start making these payments. That is a very, very, very big number. So when we start to look at this and we look at where banks are right now, we're going to start seeing more and more and more of contraction. across bank lending. There's just no doubt, because they're going to start suffering more and more losses. Because what happened over the last 3 years? Last 3 years, I've said on this channel about the last 18 months that it's the greatest economic rug pull of all time that we're stepping into. And the last 3 years were the setup for that. Because you look at it, the last 3 years, since 1776, they printed 40% of all USD in circulation. Almost half of all dollars in circulation printed inside of a 3-year period. That is absolutely insane. All bills essentially were optional. Student loans are still basically optional for now. You had rent payments, they had eviction moratoriums, they had forbearances, they had even utility bills. They had everything was basically optional. They were mailing checks, PPP loans, stimulus checks, unemployment benefits. They basically just set up this artificial economy to where people felt extremely confident. And they didn't think twice about signing on the dotted line for a $700, $800, $900 car payment to buy a car, because they were making $3,000, $4,000 a month. Paying $900 a month when they didn't have to make other bills, people could afford it. But now that's all changing. Interest rates are rising. The cost of service, all that debt's getting more expensive, and they're going to start bringing forward more and more and more debt obligations, which is going to be more and more and more defaults. And so banks are not going to be lending as much money to borrowers that offer that type of risk. And that's why I've been saying credit is going to matter so much. Having a great credit score is going to matter so much in the coming, year, 6 months, year, 2 years, because they're going to start halting lending across the board. Change in bank lending standards by hiking cycle, right? Why it matters. America's banks have become more reluctant to lend money to businesses and households, an intended side effect of the Fed's rate hike campaign. New research shows that phenomenon playing out to an extraordinary degree, making credit more expensive and harder to get, all the way on economic activity and quell inflation. This spring's bank failure may have also sped up that process, though the extent to which that has happened remains unclear. An analyst from Evercore ISI finds that the shift in bank lending standards has been the swiftest, most dramatic of any recent episode of monetary policy tightening. In some ways, that's to be expected. Easy lending conditions after the pandemic recession were met with a fierce campaign to cool down the economy in 2022. Banks responded in kind. A surge in inflation and higher rates on the horizon gradually made firms more reluctant to lend for fear of how borrowers would handle the macroeconomic backdrop. Exactly. And so as we start to walk through this, look at what's going on here. So China, what's happening in China? Because this isn't just in America. Paying attention to what's happening in China also will help paint a global perspective as to what we can kind of expect here. So China's warned that some investment funds avoid selling in their Chinese stocks. The warning comes as the stock market continues to plummet. Soon they will likely make it illegal to sell stocks, like what we've seen last time during the 2020 pandemic, right? China's new home prices drop at the fastest pace as the downturn worsens. So you start to see China's getting, they're getting greatly impacted by what's going on right now. And it's not just China. You look at a variety of different countries all around the world, they're suffering their own problems. But America is built on cheap money. And when that cheap money dries up and the cost to borrow continues to skyrocket and consumers don't have access to it, we're just going to start seeing a really, really big problem in the U.S. banking system. As that's happening, commercial real estate stepping into some very, very big problems. But look at this stat here. The U.S. savings rate dropped to the lowest in 17 years. The lowest in 17 years. So worse than 2007, worse than 2008, 2009, 2010. So you start to look at this. Consumers have more debt than ever before. They are in a worse position than ever before. Wages are starting to fall. They have less money, and they're basically sucking money out of the U.S. System, the empty money supply. Look at the empty money supply over the last 10 years. So you see what's happening. This rug pull that I've been talking about is here. We are witnessing it. That's why you see the large private equity investors, very wealthy individuals sitting on mountains of cash, because they know where consumers are. Consumers are in a very, very difficult position right now, and they're waiting for that opportunity. And if you're a renter right now, you might see this next 3 years is the only opportunity that you have to really accumulate property, to accumulate some rentals, to accumulate an investment, to grow and scale a business, because you're going to witness this large shift of wealth that's about to occur. Small businesses and small business owners and mom and pop investors, they make up the backbone of America. And these bodies, these institutions are looking at these people, these entities, as an option, an opportunity to be able to go out there and pick up these deals. You're going to start seeing small business owners start selling off properties. You're going to start seeing a lot of opportunity. It's an unfortunate situation here because that's not anything that I'd want. I would never want small businesses in America to suffer large losses. But at the end of the day, what I want, what you want, doesn't really matter. It's what's actually going to happen. What's going to happen is large investors are about to take over America. That's what's going to happen. And it's up to all of us to make smart, well-informed, educated decisions to position ourselves and our family for this large wealth transfer that will happen without our consent. It's going to happen. This is the time to fix your credit. This is the time to get out of high interest rate consumer credit card debt. This is the time to potentially sell off that high-end car if you can't afford it. This is the time to kind of maybe pull back on the lifestyle if you have to, just to save money, to position yourself, to get ready for this great wealth transfer. And if you do, and you make these smart sacrifices now, you're going to be able to, I believe, multiply your net worth in the coming couple of years. I believe this is it. I mean, this downgrade, when you're looking at America's largest banks getting downgraded, they're talking JP Morgan Chase, Bank of America. You look at what's happening with commercial real estate, $1 trillion has to get refinanced in the next 12 months, $2.7 trillion has to get refinanced in the next 2.5 years. That's 1 out of every 10 commercial properties in America has to get refinanced. What people don't realize is you can only refinance that property if you have equity. Meaning, if it's a $10 million deal and you put $3 million down, the bank would give you a $7 million loan. But if interest rates went from 3% to 7%, that $10 million deal might only be worth $5 million or $6 million. They're not going to give you a loan for $7 million on a $6 million deal. They're going to want you to come to the table with millions and millions of dollars. Investors aren't going to be able to do it in most cases. They're going to hand the keys back to the bank, and I believe the bank is going to have to get rid of these assets. So having cash, having good credit, putting yourself in a really strong position is going to really help you. But what do you think about this entire situation? Drop below, hit the like button, add me on IG. And if you want to fix your credit, you want to position yourself for this great wealth transfer, we'd love to help you in my company, GreatCreditFast.com. That's GreatCreditFast.com. You can click the link below this video to schedule a free strategy session. Catch you in the next video.